Hi, this is Krizza. Welcome to our vlog where we are going to talk about merger and acquisition. First, let us define what is merger and acquisition. Merger and acquisition is a broad term used to refer to firms that join forces together and integrate their operations in order to achieve certain goals like to increase their market share, increase their market power, increase their level of diversification, or shape their competitive scope, or even to overcome entry barriers. It is widely used or popular to firms that compete to the global economy because it gives them the opportunity to create more value to their firm and all of their stakeholders. In a merger, two firms unite and integrate their operations as a strategy to expand the company's reach, reduce the cost of their operations, make use of common products that they have, and increase their revenues and grow their profits. An example for this is when Universal Robina Corporation merged with CFC Clubhouse Incorporation, which is a plastic packaging company. In this scenario, we have what we call the acquiring firm and the target firm. The acquiring firm purchases most or all of the target firm shares in order to gain control over the latter. This control gives the acquiring firm the authority to manage the assets of the target firm. The unfriendly acquisition brings us to the special type of acquisition referred to as takeover. A takeover strongly suggests that the target firm opposes the purchase and do not form the same agreement with the acquiring firm. Horizontal merger is the merging of firms that operate within the same industry. It is used to strengthen position in the market and enhance production or distribution stage of a company. It increases market power by exploiting cost-based and revenue-based synergies. Similar characteristics results to higher performance such as strategy, managerial styles, resource allocation patterns, and others. Vertical merger happens when a company acquires a supplier or distributor of one or more of its products. It gives them the ability to take control over additional parts of the value chain. Congeneric merger, also referred to as product extension merger, is the combination of two or more companies that operate in the same market sector and inhibit the same factors such as technology, marketing, production processes, and research and development. Conglomerate merger is the merger between two or more companies engaged in unrelated business activities. The firms may operate in different industries or in different geographical regions. Market power exists when a firm is able to sell goods or services above competitive levels or when the costs of its primary and supporting activities are lower. The acquisition of a competitor, supplier, distributor, or a business in a highly related industry provides a core competence that can be used as a competitive advantage. It further gives the company the ability to manipulate price of an item in the marketplace by manipulating the level of supply, demand, or both. An acquisition enables firms to gain access to new products that are related to the current ones that they have without the need of risking a significant amount of investment. Merging and acquiring firms provides a firm the access to another firm's products, which lessens the dependence on a specific product or market. It gives a growth opportunity by expanding the market scope that a company could reach and accommodate. The joint forces of two or more firms enables them to gain access to knowledge that one firm lacks. This increases the potential of their capabilities when acquiring diverse talents.
So, hello guys, na-tackle lang niya kanina ni Krizza Jane yung tungkol sa mergers, definitions ng mergers sa acquisitions. So, ngayon naman, pag-uusapan natin ng tungkol sa problems at mga cause ng failures ng mergers sa acquisitions. At isa pa yung procedures at steps ng mergers sa acquisitions. So, simulan na natin yan guys.
One eternity later.
So, hello guys, tuloy na natin ang ating video. So, maliwanag ang aking likuran. Parang kinukuha na ako ng langit. Pero tuloy natin. Mas punta muna tayo sa problems. So, punta tayo sa problems sa mergers at acquisitions. Isa-isahin natin. So, una, yung
lacking a good motive for the acquisition. So problems of mergers and acquisitions begin even before a deal takes place. As soon as you don't have a good answer to the question, why are we doing this? The merger acquisition has just run into its first problem, and the chances of others arising are already higher as a direct consequence. So malaki yung tendency na mag-fail lang yung pakipag-merge mo o yung pag-acquire mo sa isang company kung wala yung motibo, kung di mo pala sagot yung bakit mo gagawin ito, bakit ka makipag-merge, bakit mo i-acquire yung isang company. So as a good way to avoid this issue in mergers and acquisitions from happening is to spend time on strategic planning. Go back to basics, establish what you want and whether merger and acquisitions is even the way to go about. Sa pangalawa ay targeting the wrong company. Halimbawa, ang business mo, nagbebenta ka ng motor, tapos lang naman makipag-acquire ka, makipag-merge ka sa sa business na nagbebenta ng agricultural supplies like PMAX, mga ganun, insecticides, ganun. So, success in merger and acquisition is acquiring the right firm. So, dapat compatible yung dalawang company nyo. Overcoming this problem may require you to step away from the process entirely if you don't encounter the right company in your search. So pangatlo ay ang overestimating the synergies. In simplest terms, synergies occur when 1 plus 1 is greater than 2. So, ibig sabihin nito ay kapag nag-increase yung revenue mo o cost savings dahil sa nangyaring as a consequence ng transaction na nagawa compared nung wala pang naganap na merger o acquisition, mas mataas na ngayon yung kinikita mo o cost savings mo dahil sa magkikipag-merge mo sa pag-acquire ng isang company. So to avoid overestimating synergies, conservatism is the best approach. For example, when it seems like you can make savings of $1 million, divide that by number 2. So if you still feel that's a synergy that makes the deal worthwhile, then it may be worth pursuing. So pang-apat ay yung overpaying. Without question, the most common problem that arises in mergers or acquisitions is overpaying for companies. So diba yan? Isang accounting principle, yung cost-benefit approach. Dapat mas mataas yung nakuha mong benefit kaysa sa magagasto mo o magagasto mo. A good way of avoiding overpayment is by looking at a suitable value for that firm as a limit but not a target. This is small but important shift in thinking can end up saving you millions of dollars and overcome the overpayment problem. So ang sunod ay yung losing the trust of important stakeholders. So human capital is a significant part of most modern businesses, and yet many acquirers pay this fact a little attention, leading to more mergers and acquisitions challenges. Losing the trust of either is a massive problem in mergers and acquisitions. So para maiwasan to, it's not enough to be transparent. Instead, they've got to say that they'll benefit from the transaction. in some way too. So ipakita mo sa kanila na sa mga stakeholders mo na magbe-benefit din sila sa transaction para manatili yung tiwala nila sa iyo at patuloy yung pagsuporta nila sa company mo. So ang next ay ang failing to pull out of a deal when all evidence says you should. So avoid this business merger issue by remembering that the reason you conduct due diligence in the first place is to let you know what you're buying. So parang pagkita mo na sa ebidensya na hindi ka dapat pumasok sa transaction na yan, huwag mo na ituloy. So if that turns out to be something that you don't find as attractive as you once did, don't hesitate in pulling the plug on the deal. Sa mga nabanggit na problems no, sa mergers at acquisitions, di ko sure kung alin dun yung pinakamahirap na i-overcome, pero ang sure ko lang ay merong problem sa merger at acquisition. However, education and knowledge, especially practical lessons from experience, practitioners can help you overcome the issues in mergers and acquisitions. That's all. Punta naman tayo ngayon sa procedures, no? Procedures sa mergers and acquisitions. So, ang una sa step dito sa mahiwagang script ko ay yung determine growth markets or services. Leaders start the acquisition evaluation process by identifying growth opportunities in business or service lines, market served, or any combination thereof. To determine growth markets and services, leaders must collect and analyze extensive data including the following: client origin, demographics, employers, other competitors, business program and service mix, field staff, employees, utilization, competitive cost or charge position, and consumer preferences. Pangalawa ang identify merger and acquisition candidates. The second step of the acquisition process involves the proactive identification of the universe of potential merger or acquisition candidates that could meet strategic financial growth objectives in identified markets or service lines. This involves methodically identifying likely suspects as well as outside-the-box possibilities based on management experience, research, the use of consultants, and other methods. Assess strategic financial position and fit. At this stage, following questions shall be answered. What are the likely benefits of a transaction with this acquisition target? What are the risks? How does this target compare to other targeted opportunities? Financial position. A comprehensive evaluation of the financial and credit position of the target and the combined entities is based on solid utilization and financial forecasts. The assessment focuses on volume, revenue, cost, and balance sheet considerations. Pang-apat, make a go or no-go decision. Corporate leadership must determine the likely benefits and drawbacks of the proposed acquisition or merger according to the questions discussed earlier and make a high-quality decision. During the decision-making process, leaders identify whether the strategic value-added case for a combined entity is compelling enough to proceed or not. Panglima, conduct valuation. The fifth step in the acquisition process involves assessing the value of the target, identifying alternatives for structuring the merger or acquisition transactions, evaluating this, and selecting the structure that would best enable the organization to achieve its objectives, and developing an offer. There are three key valuation methods: discounted cash flow analysis, comparable transaction analysis, and comparable publicly traded company analysis. To identify a realistic valuation range, corporate leadership should select best suitable method. Perform due diligence, negotiate a definitive agreement, and execute the transaction. Once an offer on the table is accepted, leaders of the acquiring organization must ensure a complete and comprehensive due diligence review of the target entity in order to fully understand the issues, opportunities, and risks associated with the transaction. Due diligence involves a review of the target's financial, legal, and operational position to ensure an accuracy of information obtained earlier in the acquisition process and full disclosure of all information relevant to the transaction. After due diligence is completed, the parties negotiate definitive agreements. Any regulatory approvals necessary for consummation of the transaction are obtained and the transaction is closed. During the transaction execution, the acquirer should monitor the acquisition or merger to ensure that the negotiated transaction continues to meet the goals and objectives established for the transaction at the end of the strategic assessment. Implement transaction and monitor ongoing performance. The analysis seeks answers to such questions as: will management make the tough operational changes required to achieve the financial benefits? What are the HR implications? Is there constituent support? What are the legal and regulatory challenges? What are the financial, organizational, and community-related risks of failure? A successful merger or acquisition involves combining two organizations in an expedient manner to maximize strategic value while minimizing distraction or disruption to existing operations. This includes having a ready mechanism to deal with any future problem in the implementation of the deal.
Since we already know the basic concepts of merger and acquisition, we will now proceed to its accounting for acquisitions. Basically, ang accounting for acquisitions is governed by PFRS 3 business combination. So yung i-discuss ko lang ngayon yung mga basic concept. Hindi na po tayo pupunta dun sa mga advanced, no? Sabi natin kanina, meron tayong iba't ibang klase ng acquisition. At yung pinaka-common ay asset acquisition at stock acquisition. So, ang basic explanation na lang po dyan would be the asset and stock. Ibig sabihin, ang ina-acquire ni acquirer or yung buyer ng business would be asset under asset acquisition and stock under stock acquisition. Stock or shares. Under asset acquisition, usually yung mga acquiree o yung mga seller ng business is mga undergoing liquidation. Yung mga nagte-terminate na ng business kasi maaring nalulugi na sila or maaring wala nang ma-earn na income yung business unit nila, kaya binibenta na lang nila yung mga assets sa mga contracted buyer. Basically, sa asset acquisition, ang ina-acquire ni acquirer yung asset at ina-assume niya yung liabilities for a consideration. Ang equation natin dyan would be A plus B is equal to A. Si A yung acquirer at si B yung acquiree. Bakit ang natira na lang is si acquirer? Kasi nga, si B is, yung business unit niya is nagli-liquidate na. Meaning to say, wala na siya dun sa equation. Binili na ni acquirer lahat ng asset niya at inassume na yung liabilities, kaya wala na siya dun sa equation. Diba? Goods na yun. Sa stock acquisition naman, hindi siya necessarily resulted from liquidation unlike kay asset acquisition. It is a transaction involving shares kung saan si acquirer, bibilhin niya lang yung shares ni acquiree to obtain control of the acquiree. So, ang mahalagang word dito is control. Pag walang control, hindi na po siya under sa PFRS 3 business combination. Hindi po siya govern netong standard na to. Parang wala tayong paki doon. Ang equation naman po dito sa stock acquisition would be A plus B is equal to C. Under stock acquisition, si acquiree ay mananatili pa rin mag-i-exist even after the acquisition. And we called them as a parent, as the acquirer, and subsidiary. To sum it up, sa asset acquisition, wala na si acquiree. Sa stock acquisition, nandito pa rin si acquiree. So, bakit mahalagang malaman itong dalawang type of acquisition na to? Well, itong mga acquisition na to is very common in real life, sa business world, no? At magkaiba yung treatment nila sa accounting. Magkaiba yung ini-entry natin sa book. Sa asset acquisition, syempre, ang re-recognize natin dyan would be asset. And yung in-assume natin na liability. Sa stock acquisition naman, re-recognize natin dyan yung investment in subsidiary. Kasi nga, meron tayong tinatawag na parent and subsidiary under stock acquisition. So, yung investment in subsidiary represents your ownership on the business. So, basically, yun yung shares na binili mo kay acquiree. Before going sa computation, meron muna akong ipapakilalang mga formula. Under PFRS 3 business combination, sabi doon, on acquisition date, the acquirer computes and recognizes goodwill. So, ito yung special feature sa business combination. Pag mag-acquire tayo ng business, meron tayong nare-recognize na goodwill. So, ano-ano nga tong mga to? Umpisahan natin sa consideration transferred. Ang consideration transferred, ito yung mga consideration like cash, non-cash asset, equity instrument na tina-transfer ni acquirer kay acquiree. Ito yung mga ginagamit niya upang mabili yung business ni acquiree. Could be cash, could be non-cash, could be land, property, or equity instrument like issuing your own shares, no? Yan lamang to sa halimbawa ng consideration transferred. Kumbaga, ito yung mga payment mo kay acquiree. So, yung consideration transferred is measured at fair value. Second one is non-controlling interest in the acquiree. To better understand this, meron ako example. Si ABC acquires 80% interest in XYZ. Ang controlling interest doon would be the 80% yung in-acquire niya. At yung non-controlling interest naman, yung remaining, which is 20%, computed as 100% less 80%. So, ba't siya tinawag na non-controlling interest? Kasi yun yung hindi in-acquire ni ABC. Yun yung minority interest na hindi in-acquire ni ABC. Paano naman kung in-acquire lahat ni ABC? Lahat ng interest ni XYZ. So, wala na tayong ilalagay sa non-controlling interest kasi kontrolado mo na lahat yung interest ni XYZ. Controlling interest is measured at fair value or the NCI's proportionate share in the acquiree's net identifiable assets. The third one is previously held equity interest in the acquiree. So, hindi na natin to masyadong i-discuss kasi hindi naman tayo advanced accounting pa, di ba? So, next is fair value of net identifiable assets acquired. So, ito po yung asset ni acquiree na naka-record sa balance sheet niya. So, meron tayo dapat record ni acquiree dun sa mga assets and liabilities niya, no? So, the only assets or net assets na kukunin natin would be the asset that is measured at the acquisition date fair value. Wala tayong pake sa carrying amount. So, kaya siya sinawag na net identifiable assets kasi i-deduct na rin natin dun yung liabilities. At one thing to note here is the word identifiable assets. Bakit? Kasi yung mga unidentifiable assets ay hindi na natin nare-recognize. Like goodwill na na-record ni acquiree prior to the business combination and assembled workforce like potential contracts. Di na po natin siya nare-recognize. Only the identifiable assets. Siyempre, meron pang mga ibang principles under dito na sa advanced accounting na natin malalaman, no? Hindi na natin siya masyado papakialaman. After knowing these terms, kailangan na natin i-follow yung formula, no? Pag alam na natin yung mga value, i-input na lang natin siya dito. Like, we add consideration transferred by non-controlling interest, and then add previously held equity interest, and then the total balance will be deducted, no, by fair value of net identifiable assets acquired to get the goodwill. Like for instance, meron tayong total balance na 100 at meron din tayong fair value of net identifiable assets acquired na 80 na kapag dineduct natin ay merong positive balance, ito na yung goodwill. Sabihin, dun sa total na payment na ibinigay mo at dun sa na-acquired mo, ang difference dun, kung positive, is goodwill. Pero paano naman kung ang total balance is 100 at yung fair value net asset is 120? So, sumobra na yung fair value of net asset. Ang kakalabasan niyan is a negative figure. Ang tawag natin dito is negative goodwill or gain on bargaining purchase. And i-recognize natin siya, syempre, as gain. Paano siya naging gain? Well, kung titingnan natin, yung fair value na net assets na na-acquired natin is much bigger dun sa binayad natin. Ibig sabihin, you receive something much bigger dun sa payment mo. Kailangan natin mag-recognize ng gain. Additionally, yung goodwill is hindi natin siya ina-amortize. Nag-i-impaired lang siya over the year, which means nagde-decline lang yung value niya at kailangan natin siyang i-account, which is to be discussed in the advanced accounting. That's it for the accounting for acquisitions. Actually, marami pang mga complicated na concepts like intercompany transactions and ang dami pang mga principles like consolidation, pero di na natin siya i-discuss syempre kasi masyado na tayo advanced kung ganun. What is a leverage buyout? A leverage buyout or LBO is a transaction where a company is acquired using debt as the main source of consideration. These transactions typically occur when a private equity firms borrows as much as they can from a variety of lenders, up to 70 or 80% of the purchase price, and funds the balance with their own equity. Why do private equity firms use so much leverage? Simply put, the use of leverage or debt enhances expected returns to the private equity firm. By putting in as little of their own money as possible, PE firms can achieve a larger return on equity and internal rate of return, assuming all goes according to plan. Since private equity firms are compensated based on their financial returns, the use of leverage in an LBO is critical in achieving their targeted IRR, typically 20 to 30% or higher. While leverage increases equity returns, the drawback is that it also increases risk. By strapping multiple tranches of debt onto an operating company, the private equity firm is significantly increasing the risk of the transaction, which is why LBOs typically pick stable companies. If cash flow is tight and the economy of the company experiences a downturn, they may not be able to service the debt and will have to restructure, most likely wiping out all returns to the equity sponsor. Divestiture is an act of divesting. It is the exact opposite of investing. Pag sinabi nating investing, nag-acquire tayo ng asset. And by using that asset, dun tayo kumikita ng income. Like for instance, nag-invest tayo sa new machine and technologies to improve the productivity, which will translate as your income in the long run. Pero syempre, hindi lang siya limited sa properties. Pwede ka rin mag-invest sa mga debt and equity securities like bonds and common stocks hoping to earn dividends and interest in the future. Sa divesting naman, they're actually doing the opposite of what investing do. Instead of acquiring an asset, we sell an asset. We dispose them. Maybe because yung asset na yon or yung division or yung business unit na yon is hindi na siya profitable. Hindi na siya, it is not performing well for the overall operations, no? So, parang nagiging pabigat na lang siya at baka pwede pang malugi yung business pag i-maintain pa natin yung operation na yon. So, yung iba, meron ding nangangailangan lang ng pera yung ah, isang company kaya binebenta niya yung business unit na yon. At meron ding to ensure business survival, uh, instead of declaring bankruptcy, they are actually selling na lang yung mga business unit hoping na it will provide solution for them, no? Instead of like declaring talaga na bankrupt na talaga yung company. So there are different type of divestiture. The first one is a spin-off. A corporate spin-off is an operational strategy used by a company to create a new business subsidiary from its parent company. A spin-off occurs when a parent corporation separates part of its business into a second publicly traded entity and distributes shares of the new entity to its current shareholders. The new entity takes assets, employees, or existing product lines and technologies from the parent in exchange for a predetermined amount of cash. The spin entity may take on debt to provide a distribution to the parent in exchange for those assets or loss of cash flow. There are certain reasons for a spin-off. A spin-off may be a method for the parent to reduce agency costs and create tax shields or to enter a new industry while retaining a close relationship with the spun-off company. It is a way of reorganizing a company's administrative structure in order to improve its profitability. When a company plans to consolidate or streamline its workflow, it can spin off a less productive division to form a new independent company. In other words, a company creates a new business entity out of its existing divisions, subsidiaries, or subunits. The new individual company is expected to be more profitable and worth more alone than it would be as part of the larger business entity. When a spin-off occurs, the shareholders of the parent corporation are not required to surrender any of their parent corporation stock in exchange for the subsidiaries. The next one is equity carve out. What is equity carve out? Through the process of an equity carve out, a company tactically separates a subsidiary from its parent as a standalone company. The new organization is complete with its own board of directors and financial statements. The parent company usually retains its controlling interest in the new company. It also offers strategic support and resources to help the new business succeed. The carve out is not about selling the business unit outright, but instead is selling a portion of the equity stake of that business. This helps the parent organization to retain its hold over the subsidiary by keeping the majority equity for itself. The equity carve out allows a company to strategically diversify into some other businesses which may not be its core operation. So, why perform an equity carve out? This strategy may be used for a variety of reasons and may be preferred to total divestment. It may be such that a business unit is deeply integrated, thus making it hard for the company to sell the unit off completely while keeping it solvent. Therefore, those looking at investing in the equity carve out are bound to consider what might happen if the parent company completely cuts its ties with the subsidiary. Since full divestment of a company might be a long drawn out affair and take several years, the equity carve out allows the company to receive cash for the partial shares it sells now. Equity carve out is adopted when the company does not expect to find a single buyer for the entire business, or it wants to have some control over the business unit. What is the benefits of carve out? An equity carve out strategy usually benefits both the parent company as well as the new company. One of the benefits is the creation of two separate entities out of the larger, old one with diversified core businesses. This in turn might just help in the separation of operations and streamline the focus on the core operation. For example, one might concentrate on production and the other subsidiary on marketing. If successful, this will increase the value of both companies due to increased profitability. And last but not the least is liquidation. What is liquidation? Liquidation is the process of selling off all the assets of an entity, settling its liabilities, distributing any remaining funds to shareholders, and closing it down as a legal entity. The liquidation process is a possible outcome of bankruptcy, which a company enters when it does not have sufficient funds to pay its creditors. A bankruptcy filing can be voluntary or involuntary. A petition to liquidate a company can be made to the applicable court by creditors who have not been paid by the company. If granted, the business will involuntarily enter bankruptcy. If a business is being liquidated due to bankruptcy, then the funds raised are first used to pay creditors. If there is any cash remaining after creditors have been paid, the residual amount is distributed among the shareholders. The price received for a company's assets can be lower than expected if the sale is conducted on a rush basis. This is because the seller does not have sufficient time to locate the largest possible pool of potential buyers, so that the few buyers contacted can bid lower and still expect to achieve the winning bids. Consequently, a common outcome of liquidation is that no residual funds are left over to pay stockholders. This may also mean that there is not enough cash left to even pay creditors. If so, the secured creditors are paid first, and a reduced payout plan is used to pay any remaining funds to the unsecured creditors.